Hello and welcome to the Investing Iguana, where we help you grow your money with smart and simple investing tips. I'm your host, Iggy, and today we're going to talk about how to review U.S. stock financial statements. If you're an investor who wants to make informed decisions about your portfolio, you need to know how to read and analyze financial statements. Financial statements are documents that show the financial performance and position of a company. They can help you evaluate a company's profitability, growth, cash flow, solvency, and valuation. There are three main types of financial statements that you should be familiar with: the balance sheet, the income statement, and the cash flow statement. Each one tells a different story about the company and its operations. Let's take a look at each one in more detail. The balance sheet is like a snapshot of the company's assets, liabilities, and equity at a specific point in time. It shows what the company owns, what it owes, and what is left for the shareholders. The balance sheet follows this simple equation: assets equals liabilities plus equity. Assets are the resources that the company uses to generate income, such as cash, inventory, property, equipment, and investments. Liabilities are the obligations that the company has to pay, such as debt, accounts payable, taxes, and dividends. Equity is the difference between assets and liabilities and represents the owner's claim on the company's net worth. The balance sheet can help you assess the company's liquidity, leverage, and efficiency. Liquidity is the ability to meet short-term obligations with current assets. Leverage is the use of debt to finance assets. Efficiency is the ability to generate revenue from assets. You can use various ratios to measure these aspects of the balance sheet, such as the current ratio, the debt-to-equity ratio, and the asset turnover ratio. The income statement is like a movie of the company's revenues and expenses over a period of time, usually a quarter or a year. It shows how much money the company made or lost from its operations. The income statement follows this simple equation: revenue expenses equals net income. Revenue is the amount of money that the company earns from selling its products or services. Expenses are the costs that the company incurs to generate revenue, such as cost of goods sold, operating expenses, interest expenses, and taxes. Net income is the difference between revenue and expenses and represents the profit or loss of the company. The income statement can help you evaluate the company's profitability, growth, and margins. Profitability is the ability to generate net income from revenue. Growth is the rate of increase or decrease in revenue or net income over time. Margins are the percentages of revenue that are left after deducting expenses. You can use various ratios to measure these aspects of the income statement, such as the return on equity ratio, the revenue growth rate, and the net profit margin ratio. The cash flow statement shows how much cash the company generated or used from its operating, investing, and financing activities. Operating activities are the main sources and uses of cash from the company's core business. Investing activities are the cash flows related to the purchase or sale of long-term assets, such as property, equipment, and investments. Financing activities are the cash flows related to the issuance or repayment of debt and equity, such as loans, bonds, shares, and dividends. The cash flow statement can help you assess the company's cash flow adequacy, quality, and sustainability. Cash flow adequacy is the ability to generate enough cash from operations to cover investing and financing needs. Cash flow quality is the degree to which cash flow from operations reflects net income. Cash flow sustainability is the ability to maintain or increase cash flow from operations over time. You can use various ratios to measure these aspects of the cash flow statement, such as the operating cash flow ratio, the cash flow to net income ratio, and the free cash flow growth rate. Now that you have a basic understanding of the three main financial statements, you might be wondering where to find them. Well, there are several sources that you can use to access financial statements of U.S. companies. One of them is the SEC website, where you can find the official filings of public companies, such as the 10-K annual report and the 10-Q quarterly report. These reports contain detailed information about the company's business, risks, strategies, financial statements, and notes. Another source is the company's own website, where you can usually find a section dedicated to investors or shareholders. There you can find financial statements, annual reports, press releases, presentations, and webcasts. You can also use various financial websites and platforms that provide financial data and analysis tools for investors and traders. Some examples are Yahoo Finance, Google Finance, and Bloomberg. Of course, reading and analyzing financial statements is not an easy task. It requires a lot of time, effort, and skill to interpret the numbers and ratios and draw meaningful conclusions. That's why it's important to educate yourself on the basics of financial accounting and reporting, as well as to use reliable sources and tools to help you with your research. If you want to learn more about how to read and understand financial statements, I recommend you check out this online course from Harvard Business School online. It will teach you how to use financial information to make better business decisions and communicate effectively with financial professionals. That's all for today's video. I hope you found it helpful and informative. If you did, please give it a thumbs up and subscribe to my channel for more investing tips. And don't forget to hit the bell icon so you don't miss any of my future videos. Thanks for watching, and I'll see you next time on the Investing Iguana.